The pound fell to a record low under $1.04 as the global wave of selling over the UK currency intensified during Asian trade, leaving London traders looking at levels last touched in the 1970s at the start of European trade. After quasi-quarting's mini-budget/taxes and UK government borrowing costs spiked higher, concern across international markets about the implications for the UK's public finances continued to set the mood. Economists have warned the impact for inflation could result in rates having to stay higher for longer. London traders logged on to find the pound has touched its lowest level against the dollar since the 1970s, down by almost 5% during Asian trade to a low under $1.04, as international markets continued to dump the UK currency after the government's mini-budget. Concern about the impact of the biggest package of tax cuts in a generation on the UK's public finances continued to set the tone to trade after government borrowing costs spiked higher after the measures were outlined by quasi-quarting, the Chancellor, on Friday. Susanna Streeter, senior investment and markets analyst, Hargreaves Lansdown, said, "The pound has been on a fast downwards track of a rollercoaster, plunging to record lows yet again this morning, as confidence in the government's economic management continues to evaporate." But comments by Chancellor quasi-quarting that he will go even further with historic tax cuts, which are already being criticised as reckless, have added to the anxiety. The worry is that not only will borrowing balloon to eye-watering levels, but that the fires of inflation will be fanned further by this tax giveaway, which offers higher earners the bigger tax break. Meanwhile, London's FTSE 100 ticked higher in opening trade in London, with companies earning foreign currency rallying, on the prospect of the weaker pound flattering their profits when converted from revenue in dollars and euros. The main London stock index gained 11 points to 7,029.85, a rise of 0.2%, which stood out as continental European bourses slipped by similar margins. Multinationals took up prominent slots on the leaderboard, with global consumer goods giant Unilever at the top, up over 3% at 41.54p. GSK, the vaccine maker, was 2.4% stronger at 13.45p. Diageo, the worldwide exporter of premium drinks brands, gained 1.5% to 38.33p. The biggest losses came for companies more exposed to the domestic UK economy. House builders made the biggest single losses, on concern that the potential inflationary impact of the government's tax cuts making bigger rate rises from the Bank of England more likely, making mortgages more expensive. Persimmon fell 5.5% to 12.99p, and was the biggest single faller. Taylor Wimpey was down 2.8% at 100p. London-listed companies with costs in dollars also stood out. IAG, the parent of British Airways, fell 3% to 100p.